Let's go to Twitter, if we will. What's the dynamic right now?
People love this deal. People are clamoring to get the stock.
Nobody's listening to you.
Nobody's listening to, no, well, listen, people listen to us later, right? Today, it's about getting the stock. Tomorrow, it's about understanding what the company does.
You don't know what the company does.
We have an opinion about what the company does. There's just picking up on the news roundup. There's an interesting story in the Journal today saying that the estimates from one analyst to another can range between 30 and 60% growth for next year. Right? People don't have a lot of good data about what this business does, right? People understand and are very aware of a product that they like and they want to own, right? We're going to get familiar with the business over time as the company seasons in the public market.
So the fact that it's so familiar and people are so excited about it, how does that translate into a valuation? How do you put a price on that?
Well, so this is sort of interesting, right? When we initially saw the price range at first blush, it looked like they were sort of comparing this to Facebook, right? It was sort of a discounted Facebook. Now, when we look at it, really with 150 million option shares, right, it looks a little bit priced like Yelp, interestingly, at, you know, sort of more than 20 times revenue. So a premium to Facebook on a valuation basis. From an operating perspective, we think it walks and quacks a lot like Pandora.
Well, okay, that's good, and we'll do this with Rhett Wallace here in a bit. Neil Irwin with us as well. Neil, we start a three-day frenzy, don't we? What are you focused on between Camp Draghi and Camp Bernanke?
You know, the ECB's first up, and I think that's a big test. You know, we had this very weak inflation number that came in last week on Europe. When you have 0.7% inflation in a continent with a lot of high unemployment in a lot of the southern European countries, when are they going to step in? When are they going to do something? You could do a rate cut. Will we start to see the ECB finally join the party with QE? And that probably won't happen this meeting, but might we see that in the next few months? Well, that's the big question.
And Sara, Willem Bouter yesterday with Citigroup making a big deal about how the ECB balance sheets actually shrunk. They're like the anti-Fed, aren't they?
Yeah, and that's why you've seen such a strong euro. Part of the reason it's been a strong euro and a weaker dollar. The question, as Neil poses, is will they adopt sort of Fed-like QE policies? I don't get a sense that that's coming anytime soon in the next meeting or two.
No, it's unlikely. You know, part of this is they have a strong aversion to buying government bonds. It's not something they want to do. You remember all the hand-wringing over the SMP and then the OMT that is still out there. And QE is a form of buying government bonds. That's what it is. So they're going to be resistant to it. The question is, at some point, are the numbers just too compelling?
And Scarlet, to me, to Neil's book, and the idea of Trichet, Bernanke, and Governor King of England, they've all moved on.
They've all moved on.
It's like a whole new world. We'll talk about this later in the hour.
Be Janet Yellen.
Yeah.
One thing that Mario Draghi has picked up from the Fed is this idea of forward guidance. What are we going to get in the way of forward guidance that's actually going to make a difference going forward for an interest rate cut?
Yeah, so far they've been on forward guidance. The ECB has been really timid. They've been trying to give little hints that, yeah, we're going to keep rates low for long, but they always keep that exit valve. They always want to make sure they maintain flexibility. I think they're going to have to follow the example of the BOJ, the Federal Reserve, the Bank of England, and move to a hardened kind of, yeah, we're going to keep rates low for long, even as the European economy starts to pick up and starts to improve.